Well, the possibility of future rate cuts fueling optimism in the merger and acquisition space after a slow 2023, to put it lightly. But is it all good news? Our next guest isn't so certain that rate cuts are a good thing for deal making. We're going to turn to Marc Cooper, Solomon's CEO, to tell us more. And Marc, thank you for joining us. I had the pleasure of getting a little preview conversation with you a few weeks ago, and I remember you saying you just want to keep things nice. You want rates to stay where they are so that we don't have any muck in the deal making space. Is that still your base case?
That's my wish case. My wish case is that it's always just nice, that it doesn't fluctuate between 0% interest rates and then driving up to higher numbers to fix what ails us. So, but my judgment tells me, and by the way, hi Maddie, my judgment tells me that this year you'll see some stability in interest rates. And I don't, people are calling for rate cuts. Maybe they come. I'm not, as I think I mentioned to you last, I'm not expecting any nor betting on any. But I think this is a rate environment that we can transact in. I think a lot of what happened last year, among other things, was simply uncertainty. Where was it going to end? Or when was it going to end? What was the top end of the rates? Now that you have confidence that we're not going any higher, people can price risk.
So Marc, then what do you think activity is going to look like this year? If you do get your wish list or your wish case, I guess is a better way to say it, at this point, what do you think activity is going to look like between now and the end of the year?
Better.
Not great.
So the last year was a tough year. And it was a tough year by historic standards. Now we had some mega transactions that maybe skewed the dollar volume of M&A, which I think was only down 7.5% in the U.S. But when you look at deal count, it's down, almost 20%. If you look at middle market PE, is almost down 40% in deal count. So those are some pretty significant numbers. In particular, the PE community has been on the sideline for quite some time. So I think when you look at the combination of rate stabilizing, so people could price risk with some certainty, with the idea that the PE has some pent-up demand, both to make acquisitions and to return capital to their investors, and that requires transactions. And then the last piece, which is interesting, is what drives corporate mergers. And you have a few things going on with a slowing economy or a more stable, low growth economy. M&A becomes an important way of creating growth. I think you'll see more corporate transactions. The second piece, which is cash balances. Cash balances are up, I think it was like 40+% of the S&P 500 over the past number of years. So there's some big dollars sitting on the sideline. You couple that with a more agreeable financing market, and you've got some positive ingredients that should drive M&A.
So what about how long this process is taking, Marc? I'm a little bit tired of having to talk about the same M&A deals week after week. I'm sure it gets more tiring for you than it does for me. What's taking so long?
Maddie, I wish I knew. But the answer is I'm going to give you more names, because there are going to be more names. I think what's simply taking so long is, I wouldn't tell you it was a risk-off market in M&A, particularly in the corporate side. It was more of a risk conservative market, I would say, for the private equity side. And I think that's going to turn. And we're seeing it. We're seeing it in backlog of transactions that we have in-house, which is the best backlog we've had in years. We're seeing it in pitch count. So how many PE sponsors or how many companies are looking for bankers to help them transact M&A. So it's really active. Now, I think there'll probably be some transactions in the first quarter. Those would be carryovers from last year, but I think you'll see a bigger pickup as the year goes on.
So, Marc, if we are in a baseball game here with M&A deals ticking up, what inning would you say that we're in the race to kind of speed things up here?
That's a good point. I'm not a huge baseball fan, but I'd say,
You think I'm a baseball fan? It's just for the point of the question, Marc.
Let's go for football. I would say we're on the 50-yard line, going the 50-yard line. How's
There you
that?
go.
And it's better than being on the 20 going the long way, right? So, and I think last year we were on the 20 going the long way. I certainly think we're on the 50-yard line, and I am pretty darn confident that 2024 will be a robust year. It almost has to be. And there's a lot of pent-up demand. Now, we could talk about longer-term trends, which might be different. But I think in the short term, there's just a lot of reasons why things have to get done this year.
Marc Cooper, it's great to get your insight here. Look forward to having you back and talking about some of those longer-term trends. CEO of Solomon. Thanks so much, Marc.